All right, this is another project analysis example, and project analysis is the practice of evaluating long-term assets or new projects. So long-term assets, in this case, Tom, who is the owner of the Dinghy, a bar down in Florida, this is actually almost a true story, is considering adding hot pizza to the menu at the bar. Now, they already serve ash and trash items like, pickled eggs and crap like that, but this would actually step things up because you could actually eat something that approximates a meal. So he gets a lot of customers that stop by after work for a beer, construction workers, and they don't want to have to go out somewhere and get a quick meal. So if they could get pizzas, that would also keep them staying there a little while longer. So what he has projected is that he can sell 1,000 pizzas a year, and the average price will be $12 per pizza. This is a little dated, but these are real numbers from back in the 1980s. It'll also increase his beer sales, he assumes, by about $3,000 per year because they might have a pitcher of beer while they're eating their pizza. All right, so the margins are pretty good on beer and pizza. The cost of goods sold for each pizza is approximately 30%, which means you have a 70% gross margin. And the cost of goods sold for beer is approximately 40%, so you have a 60% gross margin on the beer. Now, to do the pizzas, he's going to have to get a pizza oven, and he's also going to have to rewire the electric circuits because pizza ovens run on 220, not on 110. So anyway, got to get an electrician in there, and that's part of the cost of installing the pizza oven. That's the initial investment. He's going to have to spend $2,400 to put a pizza oven in. He's also going to have to spend $1,000 to buy some ingredients for pizzas. Frozen pizza crust, mozzarella cheese, tomato sauce. Now, as he makes a pizza, he's using up part of the inventory, but he replaces the inventory as he goes. So the cost of goods sold includes the cost for making the cheese and the pizza crust for individual pizzas, but he's got to have some laying around at all times so that he doesn't run out of ingredients and can't make pizzas. So that's $1,000 of inventory, but when he's through with the pizza business, he can recover that either by selling it off or just not replacing ingredients as he goes. So he assumes that the pizza oven has a life of 3 years. They actually live longer, but we're just keeping this simple. And he's going to depreciate the pizza oven over 3 years. Now, he's going to spend $2,400 to buy the pizza oven, but since it's a capital asset, you don't get to expense that. You actually have to depreciate it, which means that you write off the cost over its useful life. All right, $2,400 over 3 years, that'll be about $800 a year. All right, so he figures that he'll do this for 3 years and then he'll reevaluate. He can either buy another pizza oven and then start all over again, or he could just wrap this up, sell the pizza oven for scrap, and he thinks he can get $200 for it, and then he'd get rid of all the other ingredients at the end of the 3rd year too. All right, so those are terminal values or last period expenses. He also thinks it's going to cost you $4,000 a year in other stuff. There's more electricity to run stuff. He's got to have insurance, different type of insurance. All the other ash and trash is going to be about $4,000 per year for adding pizza to the menu. He's got an average tax rate of 30%, and his cost of capital, or his discount rate, is 15%. That's the cost that he ascribes to waiting to get his money. So if he's got to wait to get the payback on this pizza oven, he's going to discount all the future cash flows at 15%. And the question is this a good capital investment? And we've shown several of the tools we use for capital budgeting: the net present value rule, the IRR rule, the MIR rule, the payback period, and the profitability index. Well, let's see how Tom would go about doing this using financial principles. And I've already done it, but this is essentially what you do. You forecast out all the cash flows. Now, part of the cash flows are operating cash flows, where he's going to have additional revenue, minus the additional expenses. So you're going to get the marginal operating profit. You also want to make sure you get the timing of everything. He's going to have to pay $2,400 before he makes a pizza. He's got to buy the pizza oven and he's got to buy the inventory. Those are initial investments that happen at time zero. So you can't start making pizza without a pizza oven. You can't make pizza without the pizza making ingredients. Initial investments. The after-tax operating cash flows are the year-by-year cash flows, the marginal cash flows from operating this business. Okay, operating the pizza oven or adding that to his existing business. The additional beer sales are $3,000 a year. The additional pizza sales, $12 a pizza times 1,000 pizzas a year, $12,000. So the marginal revenue from adding pizza to the menu will be $15,000 each year over 3 years. Now that marginal revenue, we have to recognize the expense. The cost of goods sold for beer is 40%, so 40% of $3,000 means that he's going to have to spend $1,200 in order to get the additional $3,000. The pizza has a 30% cost of goods sold, and that's as he's taking it out of the inventory, he replaces it in the inventory, but it's about 30% of the $12,000 goes to paying for the cost of goods sold for selling the actual pizza. So that's negative $3,600, basically negative 0.3 times the revenue. The ancillary expenses, he projects it's an extra $4,000 for extra insurance and the extra electricity and stuff. And he's got to recognize the depreciation expense on the oven. Now the cash flow occurs at time zero, but you don't get to take that off of your income right away. You actually have to depreciate it. And you depreciate tangible assets, you amortize intangible assets. But a pizza oven, if you can touch it, that makes it a tangible asset. And it's a long-term asset. So it's depreciated, straight line, $800 a year. Which means that the total marginal operating expenses are $1,200 plus $3,600, which will take you to $4,800. Plus another $4,000, that'll take you to $88,000. And when we add all the numbers together, which I've done here, the total comes to $9,600 a year. That's accounting numbers. So the operating profit, and you pay taxes on operating profit, if his tax rate's 30%, his operating profit just from this adding the pizza oven and selling pizzas, the operating profit would be $5,400, which he'd pay an additional 30% of that as taxes, which means his after-tax profit is $3,780 per year. However, the cash flow is higher. That's because when you look at the depreciation on the oven, we didn't spend that in year one. We actually spent it in year zero. So I've got to add that $800 back to the after-tax accounting profit to convert it into an after-tax operating cash flow. And those are the dollar bills that'll show up in the cash register over the next 3 years. At the end of the 3-year period, assume he sells the pizza oven for scrap. Now it's fully depreciated, so if you sell a fully depreciated asset for more than the book value, you're going to owe income taxes on it because you took too much depreciation. So he'll owe 30 cents on the dollar on the $200 gain he has here, and he's going to sell off the pizza inventory. That is, in the last month or so, instead of replacing a mozzarella cheese, he just doesn't replace it, and that means that he'll get back that $1,000 of inventory at the end. All right, now I've highlighted in yellow all of the cash flows. Add them together, and I have the cash flows per period. And then I do the normal calculations. The present value of the future cash flows in each of the 3 years is $11,207. He's got to spend $3,400 to get that, so it's got a net present value of $7,807. The internal rate of return is 127%. The modified internal rate of return is 71%, and so that's higher than his 15% cost of capital. So that's acceptable. It's a profitability index. It's bringing in $3.30 of present value cash flow for every dollar of initial investment, and that's pretty good. And it pays itself back within less than a year. So all in all, Tom's Pizza Oven has a positive net present value. Its IRR and MIR better than the cost of capital, the 15% cost of capital, a profitability index greater than 1, and it's got a very short payback period, so it's probably a very good idea for Tom to go out there and buy this pizza oven, assuming that all these cash flows turn out to be like he predicted. It would be the equivalent of finding $7,807 on his doorstep today. The net present value, the value coming in is worth $11,207 today. The value going out would be $3,400 today. So it's the equivalent of his business getting $7,800 more valuable just by making this decision and implementing it.